Howdy, Jacob here. Today we're looking at Canadian Pacific Kansas City Limited in the ground transportation industry, 72.6 billion market cap on 86 billion enterprise value, incorporated in 1881. They own and operate a transcontinental freight railway in Canada, the United States, and Mexico. So the North American area, their growth is not going to be substantial, very likely, as they've been around for quite some time. We do see very heavy growth recently, very likely an acquisition. Outside of that, I wouldn't expect much more growth than inflation. Operating margin and gross margin are both very impressive. An operating margin in 35% the most recent year is crazy high. That is a massive operating margin. That's like almost Microsoft status operating margin for a ground transportation industry company. That's just very interesting to me. The dividend pays out very little compared to their earnings per share, so we'll see what they do with their capital allocation. They used to have a pretty good return on invested capital. It's dwindled down to mid to upper single digits. It's not as impressive recently. Balance sheet shows 346 million cash and cash equivalents, with 2.3 billion due short-term debt, 14.4 billion long-term debt. Quite a bit in net debt here. And it looks like they have, let's say $2 billion of production of free cash flow. In relation to that, 12 billion, and it's a little over 6 years. So they do have a good amount of debt, and honestly, a good amount of short-term debt as well, of 2.3 billion in relation to their cash flow. That's about with all the cash they have on hand in a full year's production of free cash flow, that's 100% of it. And so their capital allocation right now is, so they're going to have to refinance that, in all honesty. Capital allocation now is 523 million towards dividend, and then the last 3 years, a substantial amount, well over 50% of capital allocation going towards debt reduction. So with the amount of debt they have on hand, we're going to have to project a bit of their capital allocation going towards debt reduction. For me personally, it'll probably be in that 30 to 40% range. So we'll say that maybe 25 to 30% capital allocated goes to the dividend, 40% or so to the debt reduction, leaving just 20% or so to acquisitions and reinvestment opportunities that make sense for them. So let's get right to it. On the revenue growth side, honestly, I'll probably just do 4%. I think railways and ground transportation companies as them have kind of a dominance. I think their inability for other companies to join and just start an endeavor to try to compete with them would just take too long, too much capital. There's too many opportunities elsewhere. So I just don't think that. I think there's a big barrier to entry, which I think gives them somewhat of a premium. So I'll give them a slight premium. Even though their growth rate isn't likely greater than market, I do think that their barrier to entry is definitely greater than market. And their margins are very impressive. I don't like that free cash flow is so much lower than earnings, but I think that's fine. Nothing that I'm going to complain to my mom about. All right, so the dividend has been increasing a little bit, not as much the last 3 years. Maybe I'll increase their dividend with revenue growth, saying that their payout stays roughly the same at 25, 30%. And again, we're assuming about 40% to debt reduction, leaving just 20 to 30% to reinvest and make acquisitions to get this type of return, these type of margins. And the company's stock price needs to fall 65% from here. So for me at this moment, I do think this fantastic company based on operating margin and barrier to entry, but I do think there's a little bit of things that I'm a little bit skeptical of, and it doesn't seem to be at the most obvious of cheap prices for me at the moment. Either way, I hope you enjoy the video and have a great rest of your day. Thanks.